Everyone welcome Mark Newton to our community. This is a return interview for Mark. He was on here in April. Hi, Mark. How you doing, buddy? Waiting to hear your voice. Looking at all your DeMark numbers here. How's your microphone?
Hi there, Dale. Can you hear me now?
Got you, Mark. Yes, Mark.
Okay, great.
Thanks so much for stepping up and coming in here today. I thought it would be a great time because kudos to you. When you were here in April, you said there was really nothing to stand in the way of further market strength, that you were sanguine, but that there were going to be some changes. See, I remember everyone's trades and everyone's interviews occurring in July and August. And then I noticed a tweet by Andy Nyquist of See It Market that you published an article that addressed exactly that. So welcome back, my friend.
Thank you very much. I appreciate you having me. Yeah, things, there's still, you know, a few things that suggest that markets can in fact go higher, but increasingly, you know, we're starting to see a couple things that are a little bit problematic that could spell at least a period of near-term weakness. And so, you know, it might be important to talk about those with regards just to equity.
Yeah, maybe you could go over that piece that you wrote for See It Market and what you saw as, you know, I believe that some problems were developing was kind of the bullet point of the article.
Well, the first and foremost, you know, most people look at trends, and myself as a technician, nothing has changed with regards to that. Obviously, trends have still been quite constructive with regards to most U.S. indices and sectors. I think globally, things have gotten a bit stretched of late. Part of my point just rested on the fact that when you look at things like the Bloomberg World Index, you'd gotten very overbought, very stretched. You're now at levels where you do see some signs of counter trend sells based on DeMark. And just looking at this trend since the latter part of 2016 or the election, the run has been nearly uninterrupted. But we're at levels now where potentially we could see some back and filling here, a little bit of consolidation globally. And so my thinking is that that also could affect U.S. stocks as well. Most of it has affected Europe. We have seen most of Europe sell off since peaking out in mid-May, and so I think that's
something else you talked about, Mark. You know, everyone was, you know, moving their money overseas, especially Europe, and I believe, and I remember you saying that you thought it was time for that trade to move the other way, and the DAX has been really the one under pressure, mainly due to, you know, what's happening with the euro. But that was another great call. When everyone was going into Europe, you said you thought that trade was the other, it could come in, and that's exactly.
Well, we saw sentiment get to pretty bullish extremes with regards to Europe as well as on the euro, and so, you know, we have seen a little bit of weakness thus far in the DAX. My thinking is that it really is near make or break here. We really need to show signs of finding support and holding pretty quickly. We can't really afford to have, you know, the DAX get under 12,000, which would really kick off a larger period of weakness, I think, for Europe and potentially the U.S. Just to get back to your original question, I think the key things to watch for most investors and traders with regards to U.S. stocks are a couple things, and one is that we had gotten fairly overbought. We saw that in the Bloomberg World Index I showed, as well as U.S. Markets as well. And momentum really has not followed this move to new highs of late, because we were largely sideways since the early part of June, late May, early June. And so it's tougher to see that on a weekly chart. But this grinding period, we saw a spike in momentum in March, and that really has not been bested. And so that's a little bit of a concern, this little growing negative divergence per se with regards to weekly charts. The daily has gotten fairly stretched. Go ahead.
What is that momentum indicator that you use down there? Looks like it's two colors, two lines.
This is just a simple MACD, MACD, moving average convergence divergence. So it's not a really rocket science. A lot of what I use this for is just for divergences, you know, the crossovers in my opinion and experience, have limited success for causing turns. It's more just for purposes of trend following and making sure the trend's on your side if you're entering a position.
How about the
we had
green
gotten
bars?
fairly stretched, since S&P went from what 2,400 to 2,480 in a very short period of time. The first 3 months, there's 3 weeks of this month, and now we're entering seasonally a more negative time. Things have gotten overbought. You see a little bit of negative divergence. The real key, though, is going to be technology, and that's something to watch because we had a little bit of shakiness in things like the XLK. This is just obviously a very concentrated ETF for technology that holds mostly large cap tech, but most of the other technology indices really mirror this. So I think it's important to look that this pattern, in fact, did fail early on. Many thought this was just a mini little head and shoulders of sorts. We broke down, but really didn't accelerate, held for a few days, and then blasted right back up through the highs. And so now we're up right by this area near early June highs. And so given that this sector represents 22% of the S&P, it is very important in terms of what tech does. And, Google's earnings out today, a couple things that, if we show signs of pushing back up to new highs, and that means likely that this whole pullback can be delayed. But based on, some of the proprietary cycles that I run that gave turns in early April and also early June, the next period that was on my radar was really July the 20th through the 23rd, and obviously over the weekend, today and Tuesday could be included in that. But we really need to turn down quickly if we're going to do so. We've stalled out over the last couple of days. That's not necessarily all that bearish, but there are things such as technology weakness and really the weakness we've seen lately just in things like the industrials and the XLI, which have truly started to show a lot more signs of rolling over of late with the transport weakness. And if we pull up that chart, you see that, we did in fact break at least a 1 month trend. We've seen a little bit of weakness in the rails of sorts of late. You did see some counter trend signals there. But of course, this is short term only. I mean, when you pull, the longer term charts of this are still pretty resilient. So everybody's looking for the top and looking at things like implied volatility being under 10 as being a concern for the market. I think many times this low volatility can tend to persist. And so,
well, it has.
What I'd like to see for a real bearish standpoint is to see signs of credit spreads really starting to widen out, and those have been pretty resilient of late. So I'm looking really at them.
Where do you look for that, the credit spreads, to know whether they're coming in or widening out? What instrument?
Well, I just use a simple gauge of really looking at the ETFs with regards
HYG?
to HYG versus the LQD versus for the investment grade. But really, it's tougher with regards to using these just because of the flows, supply and demand within credit. A lot of these will mirror what's happening sometimes in treasury yields themselves. So it's only a real basic picture and doesn't give you really the whole, the whole picture. So some people will look at, various different, spreads and different gauges, but really it's not rocket science. It's certainly not perfected. I mean, this really blew out back in 2008, starting back in October, and credit spreads widened pretty materially, and then they've been compressed. So we've seen a little bit of a lift, slowly but surely, and crude having pulled back a little bit really didn't cause much deterioration at all in things like the HYG or JNK. So the bands have been growing lower, and now we're at an area where we do have TD sequential 13 cells on the JNK. So we'll see, in fact, if we can start to roll over. Part of my thesis was really that crude should start to move a little bit lower, that the U.S. dollar is going to bottom out, at least on a short-term basis this week or next week. And so you could see some weakness in the commodities, and if crude starts to affect, high yield, then that would be a bigger piece of the puzzle. But my cycles, aside from here, pinpoint a turn in mid-August as well as late September. And so I was thinking potentially you could see a high here and a pullback into August, into mid-month that would mark a low, and then a rally into late September. And so we'll see. If we get past the next week and we have not peaked yet, then that means we're probably going to rise into that central band of mid-August and then peak then, which would be a larger peak, in my opinion.
Maybe
But, we just need to.
maybe the market
Sure.
peaks in late August around the total solar eclipse. I think it's the
Right.
21st, 22nd.
Yeah, there's a lot of time cycles that pinpoint that exact time, and so that's important for those
Yeah,
that
that's the
study
first
any
eclipse.
sort of astro cycles.
Total.
I mean, there are a few things that also line up there that really have some importance that have coincided with really peaks and troughs in equities over the last couple of years. That's really beyond the scope of what I wanted to get into here in this discussion, but it's something that I keep tabs on a lot of time-based cycles, and do think that they can have some significance, particularly when price, of course, starts to react, which is really the key thing. It's tough to put too much stock into a lot of things that might cause equities to turn down. We all know that earnings really have very little power in that regard. The whole macro themes are really, worthless. A lot of this DC drama that's causing people to be on edge really has served to continue to cause equities to move higher. So none of that really works. A lot of it is just sentiment and cycles. And so the sentiment arguably has gotten a little more constructive with regards to institutional investors, but with retail investors, I would argue, there's still a lot of skepticism in there, a lot of frustration, and there's certainly no real signs of ebullience like you saw in 07 or 2000 that would say, okay, we're at a peak. So it's more of a muted type, begrudgingly bullish type stance where people are gradually getting more and more optimistic, and we're seeing those overweights reflected in a lot of the portfolio managers' data with having, being long to stocks, but yet still an underweight to U.S. stocks. And so that's interesting, but the cash levels, might be something to watch there in the weeks ahead. So my thesis of being negative, and I've been positive on the market really for the last few months, but I said, we're in a window now where the cycles could turn. You have XLK right up near former highs. So technology, if we start to stall out, or if we have negative earnings by a couple of these, that could be important. Momentum has obviously slipped in the tech sector of late based on this June minor little sell-off, which really didn't see much follow-through. But tech is going to be a key piece of the puzzle. The divergences, but for me, it's all about the price action, and I really want to see to be truly bearish. I mean, you need to see signs of the rally from November lows being broken, as well as the lows from last February, and so that's going to take at least a move down under 2,400 at a minimum, and really down under almost down near 2380 to show okay that we're really starting to peak out. So for me, we're in the window for a short-term peak. Whether it turns into a large one or not, we'll wait and see. It's not. That's never the way I've tried to manage my own money or instruct others, is to make these long-term grandiose projections that might or might not work out. You really have to follow the price action and stay on top of it, and that's really the key to success in my view.
So as Amazon goes, most likely will be as the technology index goes, and Amazon made a new high. I don't think it's confirming, but there's Amazon.
Yeah, what's interesting, so I put together a little basket of the so-called FANG names, and I think it's typically wise to see how this is doing, and you see that this started to dip, and we really didn't get much follow through. We're still pretty extended. We did get counter trend sells back in early June on the FANG space. Momentum is barely positive, but we've sort of, things like MACD have sort of fish hooked a bit, and often that can be problematic where the trend goes higher, but yet we're still struggling to make highs of momentum given that we're so stretched above this longer term trend just from back in 2015. So we could certainly afford to give some back, but yeah, I look at stocks like Facebook or Google, which, today having earnings and this is sort of an interesting potential bellwether that needs to be looked at pretty carefully. And so the daily charts argue that this stock, is up against pretty key levels. We made sell setups. So this is very similar to what's happening in the XLK. So it's almost a mirror image of what's happening. So you look at Microsoft, you look at Facebook and Google and Apple, and those will give you a feel for, obviously the larger tech sector, the way that most people tend to think about technology.
So let's talk about where retail was right, and a lot of people were fading them. They were long the euro all the way up. I'm interested in your view in the Dixie. You said you're looking for some type of short-term low coming in here in the next week or so.
Yes.
Do you have any levels that you're looking at? And do you think that it will just be, after this type of decline, just another bear market rally and the dollar trend has changed from a secular bull to a secular bear?
Yeah, okay, let's address these first things first. So I want to look at the euro, obviously, given that that's such a large component of the DXY, and some of this is based on the combination of DeMark signals along with sentiment. And so we're really on the window of being within 1 to 2 days of what's called a 9-13-9, where we have a completed TD sequential and combo pattern, and then we have a sell setup, which is approaching with 9 consecutive closes above the close from 4 days prior. And so when that happens, typically you tend to get a reaction. Now, we have bested the highs from back in 2016, but as you know, we still have the previous peaks from back in 2015 that we're sort of wrestling with right near 117, at least on an intraday level from back in August. So the broader picture and how this lines up is you look at, the breakout was pretty constructive. It could have gone one way or the other. I think the last time we spoke, we were up against good levels, and I wasn't really all that sure. I wanted to see proof, and obviously this sort of changed things for the better with regards to euro versus the dollar. And so now we've gotten a little stretched in the short run. You see, classical technical indicators having reached overbought levels. Based on the daily chart alone, I think that we're in the window here in the next couple of days for at least a short-term pullback to right near probably 114.5 or so, and we just haven't seen that bigger breakdown, and we need to see that to really turn truly negative on the euro, or vice versa, being positive on Dixie, to think that we get this large move. Right now, a lot of this just suggests that we're going to see near-term exhaustion sometime this week and give a little back. So I don't mind being negative here at 116.38, risking, up to 117, spot 25, and thinking that we start to sell off and get down and can give back a little right down to, an area towards the lower part of this Bollinger, which would be a decent area, I think that. But, you see a couple different things as part of this process. One that is interesting is the fact that dollar yen is also down at a level where the dollar could start to mark some type of a low and really start to rally. The issue, though, is when you look at the market indicators, that this is now through this so-called TDST. We've got the 9 count. If that's perfected, and that's going to drive it even further. But I do think we're in the band where the dollar can turn, and as the dollar turns against yen, against euro, that should mark at least some sort of a tradable type low in the dollar. As to your larger question, I was thinking that we'd actually start to snap back and could see a final move higher in the dollar before the peak that met this year's highs in the dollar overall. We are in this 16.5-year cycle where, since the last time the dollar really peaked out in the early 2001, that we are in the window now for another peak in the dollar. And so we take a look at longer term charts like DXY. I'm gaining conviction that this potentially could have been the larger peak that we were looking for back in December, and then we could just see rallies might prove brief, and we have just a further deterioration in the U.S. dollar overall. So you could see a little bit of a snapback. We have gotten overdone to the downside. Larger pattern was pretty constructive on this up until we really broke down, right down here in early May, and that's really a time when everybody from a trend following perspective had to realize that something in fact had changed. You can consolidate a bit, but once you see this break that happened in mid-May, you realize that really all bets are off, and you can throw this pattern out the window. And so now, you can have a brief pullback, and you could see greater support for the DXY down near 92. So now we have maybe a short-term blip and rally, and then maybe this setup count completes, and we have a larger decline in the dollar down to, which would really fit in with the seasonal upswing in the metals potentially from August into October, and then maybe make a larger low in the dollar there. But I'm a little bit negative now on commodities being gold, silver, precious metals, along with oil. I think that we're in a window where those likely start to turn down, at least in the short run. And, gold has had a decent little lift for a few weeks' time after this break, and we're actually in a window now where, gold likely could start to see, a little bit of resistance come in. Pattern has been largely flat to range bound. Now we're up against the highs of this Bollinger. You have a number of different forces that suggest that, dollar starts to rally. You also have a window for treasury yields to turn back up as well. So the combination of those would be truly bad for the dollar. So I don't mind being out of for gold. So I don't I don't mind being out of gold longs here and considering going the other way and just waiting for this confirmation as to when to press, shorts in gold and gold stocks. But gold stocks have been the one thing that really have not lined up with gold.
No, lagged. They've done nothing.
Yeah, they've been horrendous. So now you're at an area where I think it's a decent risk reward short for things like gold mining stocks, things like the GDX, at least in the near term, that we start to pull back. The base metals are a different story, and you have this whole infrastructure reflation theme where you've seen the steels and the iron ore stocks, and they started to look actually quite constructive. So maybe this proves just short-term in nature. For the matter of maybe 3 to 5 weeks, you see a little bit of a pullback in gold stocks, and that gives you a chance to buy, as the dollar sells off further down towards May lows of last year, and that could help gold potentially into the fall. But for right now, I'm willing to take a stand and going against the metals trade and thinking the dollar is close to at least a short-term bottom where the euro can sell off a little bit versus the dollar.
Okay, well, I interviewed Raoul Paul a few weeks ago, and he uses DeMark too. And I don't know if it was a weekly chart or not, but he's similarly looking for, he's a huge dollar bull, and he's similarly looking for an important low in the dollar to come up with a DeMark signal, maybe around that 92 level. I think they'll take out the 92 bulls first, but can you still make a long-term bull case based upon DeMark once we take out 92? And then the other question is, if we're finally, I don't know when people are going to finally say, well, the bull market and the dollar is dead, and maybe we're heading into the 80s or 70s or something like that. But do you think, Mark, that part of what's going on, I heard someone say that the dollar normally suffers under Republican administrations. I think it was Howard Friend. He doesn't know why, but it does. That eventually dollar weakness is going to be, especially if it continues and is pervasive, that makes yields go up, not because of economic growth, but just to slow down the flow out of the dollar into other currencies. And then that's the bubble, that's the pin that pops the equity bubble, are higher yields.
Well, we've certainly seen a little bit of difference in how yields have moved with the S&P since March. I think last year we saw, every time yields would move up, stocks would move up with the financials, and this year has been a little bit trickier with yields starting to sell off towards from March through June, and equities certainly did not go lower. So, I still tend to be, so here's the dog to answer your first question. So, DeMark, at least on a monthly basis, we never did see these highs. So we're back in April. I thought, well, if we hold here and we could start to push up with one more move, we could get, a lot of DeMark highs right at the highs of the dollar, and then we'd sell off. In fact, it's gone the opposite way. So the break in May was important. Now we're on a TD 5 count, which would mean another 4 months potentially, which isn't going to likely materialize if we see any sort of rally in the next month. So, from a DeMark perspective, it's tough to put a real low.
The monthly says another 4 months of weakness because of this.
The monthly says that we would need to see at least 3 months, potentially 4, before we get any sort of buy setup. And so you look back over the years, you have had, sell setups back in 2005. You saw buy setups right at the lows in 2011. You saw a brief period here. there's no saying at this. In other words, the monthly chart is inconclusive, and it's tough to make prognostications just based on this being a 5 on a setup count and saying we need to go down 5 more months. That just doesn't hold water. The real key is when it gets closer to a 9 count. On a weekly basis, I think the point he was mentioning is that if you have another, 2 to 3 weeks down on the weekly, that you could form, what's called a buy setup right down near these lows. The problem is that when you take things like this former area support that's now been perfected for those that study the mark, that really nullifies this setup, and everything. It historically means that you have to go towards a full countdown before you see any sort of low. So I think the dollar downtrend from last December is still very much in force. If I can sort of simplify my comments and say that I do expect a brief rally in the next 3 to 5 weeks in the dollar, but that should be sold, and think that dollar weakness likely persists over the next few months.
What kind of magnitude of a bounce would you expect? That wasn't much that you were looking for in euro, so it's probably not much you're looking for in dollar either.
Well, I mean, just looking at just basic trends, you want to see at least some evidence of some of these trends being broken to claim that we're going to start a new rally. The momentum has been so sharply to the negative here. So I mean, if
so it's a rally to sell.
Gets up to maybe 96 at the most. I mean, I think and that's probably optimistic, but initially I'll take my cues from just the daily chart and try to see, first evidence that trends are being broken here. And so that's going to lead us, right up a little bit over 95, thinking that, we'd have to almost bottom sometime right away and start to push up. And if we take out the highs from last week, 95.16, that would be very constructive, as well as what I view as this other wave down, which ended back on the 30th of June, so 95.47. So those are the first 2 key areas, is right near last week's highs, along with the lows from late June. Getting above that would be a little more constructive, and then you face really resistance up near these lows from the spring, which fit in with the weekly chart. So, we do have a window here, but it's
it's just a crack in the window. It's just opening the window a little bit for a little pop in the dollar.
That's exactly right. I think it's a brief window for a rally, but I think the dollar sell-off likely is going to continue. That fits in with the POTUS agenda and what the administration wants. Not that they have any real control or really can do a whole lot.
When does the debt ceiling become an issue? We weren't sure. When's the debt ceiling come up again in Congress?
That's a great question. It's not something that's that I study a whole lot. I really care about being a technician, unfortunately. But I think
October.
We'll see with regards to healthcare reform, if we get anything out of this, and then on to tax reform. I think, if anything, most people realize that tax reform can't happen. It'll be probably a tax cut, if anything, and that the deficit. We'll see how that shakes out. I don't have any specific dates for you as to what I think will be important. Yeah.
Why don't you show your website and your service so that people, besides Twitter, they can get a hold of you at Mark Newton, is it CMT at the end of the Twitter handle?
Mark Newton CMT is the one that's public. I do have a private Twitter feed that for clients. It's under Newton Advisors, where for those that like stock-specific information, I give a lot more info on that. The website is under newtonadvisor.com. So it is So this is a website that I created last year. So for those that do not know me, I formerly ran technical analysis for Morgan Stanley. I also worked at Diamondback Capital Management prior to 2011. So I have I've been in the technical analysis field, in the financials sector for the last 20 odd years on both the buy and the sell side, and have done technicals. But I run really just an advisory service at this point, talking with institutions and retail. I've opened it up to really everybody trying to really help people to navigate the market more on a tactical, shorter-term time frame than maybe a lot of technicians out there. So I'm looking at really the changes in sector rotation that can help people make money over the next 3 to 5 weeks. And I really take a global macro view and looking at commodities and currencies and treasuries and equities, and really not just look at stocks that'll make you money. Though, I have a long short list that I came out with back in January on the 9th that is now up 49% through Friday. So that is 5 longs and 5 shorts. So I have had some success in some of the recommendations, and I came out with a recent portfolio called Newton's 9, which I'm happy to forward to anybody if they have interest. So my website is at newtonadvisor.com, and my email is at info@newtonadvisor.com, where you can reach me there as well. So I'd welcome everybody to check out the website, and if I can be of help to you, I offer packages for institutions, and I work with, I at least offer my work to retail, but that doesn't include any real tailored, work that I typically give institutions. I typically don't speak with.
My extremely accurate and humble opinion, you're one of the best out there, Mark.
Thank you, Dale. That means a lot. I appreciate your support and inviting me to the show. I'm happy to join whenever you guys will have me.
Thank you so much, Mark. May dollar bills and gold bullion and euros rain down on you, and when we get back together in the fourth quarter and see what's happening then.
That'd be wonderful. Have a great rest of the summer, and thank you and everybody for tuning in. I appreciate it.
All right, Mark. Everyone thank Mark Newton and follow him. And also, isn't that great? 49% on 5 longs, 5 shorts. So I want to thank everyone, Blake and Steve and all of you out there. Great questions today. And before you leave, don't forget to click the link to become a subscriber. Risk $1. Probably made more than that being long the peso from last week on Blake's call. And I'll see everyone for Turnaround Tuesday. Good hunting, and most of all, don't just count your pips, count your blessings. I'll see you, my trading warrior brothers and sisters. Enjoy your summer day.
Thank you very much, Dale. Bye-bye.
All right, Mark.